I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on PI Industries Q4 and FY21 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Mayank Singhal, Executive Vice Chairman and Managing Director, Dr. Raman Ramchandran, Managing Director and CEO, Mr. Rajneesh Sarna, Executive Director, and Mr. Rajiv Batra, Chief Financial Officer. We will begin the call with key perspectives from Mr. Singhal. Thereafter, we will have Mr. Batra sharing his views on the financial performance of the company. After that, the forum will be open for question and answer session. Before we begin, I would like to underline that certain statements made on the conference call today may be forward-looking in nature, and a disclaimer to this effect has been included in the investor presentation shared with you earlier and also available on stock exchange website. I would now like to request Mr. Singhal to share his perspectives with us. Thank you, and over to you, sir.
Yes, good afternoon, everyone, and thank you for joining us on the PI annual call. I hope all of you and your families are keeping safe and doing well during this pandemic. As you have seen, we are witnessing a very challenging time with the upsurge of the COVID-19 second wave, and our endeavor has been to maintain the momentum of the business in line with our objectives. We are doing our best to whatever measures and initiatives we can take to help those suffering and are in need. Now, I take pride in sharing the company has reported a robust set of numbers with consistency for 2021. During Q4, the revenue has increased by 40%, EBITDA improved by 22%, and the PAT reported gain of 62%. Now, speaking of the full year, our revenue has risen by 36%, EBITDA has been enhanced by 41%, and PAT stood at 62% higher than the relative to the previous year. I here must compliment the entire PI team for their excellent effort and resolve to achieve new performance milestones for the company despite the operational difficulties and challenges. The agrochemicals have demonstrated demand momentum throughout the past few quarters, and those broadly get categorized as essential products the world over. The broader specialty chemical industry has also reported attractive trends as large markets like China and the US restore scale up of economies, activities across numerous end-user industries, and chiefly automobile and construction. While the global crop protection industry is involved in line with changing crop mixes, existing and upcoming environmental regulations, and expanding population, the demand for more food across the world. Evolving economical ways to up the agriculture yield will be critical. With the help of advanced research and next-gen technologies, the global agchem industry is gearing up for the challenge. Here, PI stands apart with its commitment to put IP first. With a vast experience in science of agchem, international manufacturing and research, we deeply engage with our partners in innovation across the value chain with long-term objectives. The market for crop protection chemicals in India is also expected to expand at a compounding 8 to 10% between the year 20 to 25. And PI will constantly focus on developing products of high potential brands in the domestic arena. With India, our brand agri-input business has benefited with consistent farm extension services in our team-driven brands extended with a set of value across in the key crop regions. The recent launch of Akira has fared extremely well. Further, both Shields, a fungicide, and Londex Power, a rice herbicide that were launched in 2010 was successfully accepted in the market. A very dedicated effort is going in educating the farmers, inoculating the right usage techniques. The experience and expertise of our field officers is employed to drive volumes. Our newly acquired Pisagro, which now called Jivagro, has also done exceedingly well in consolidating our reach in horticulture segment. With a 25% growth, it contributes well in our overall growth in the domestic market. On the export front, the past year has seen an accelerated development in the pipeline of molecules by us, Having announced our year-on-year rate of commercialization of new molecules, we are devoted to maintaining that momentum. In 21, we have commenced 5 new molecules with CSM exports, another 5 to 6 at various stages of development which will be commercialized in the coming year. We see higher level of inquiries and orders, giving us a position to report healthy trajectory of profit for performance in line with our present and planned capacities. The combined benefits of the two entities in November 21 will become apparent during the course of the year. We expect another entity to be added in the coming year, thus announcing our capacities. Additional augmenting capacity utilization as the Sagar acquired facilities will allow us to pursue higher numbers of commercialization. At the same time, our run rate of shipments from the existing molecules is growing. The growth visibility remains robust. Also, we are very conscious about the ongoing COVID-19 challenges and potential risks, hence a little cautious. The domestic side, the target of rice production for this curry has been slightly higher at 104.3 million metric tons relative to the previous year. Cotton and soya are expected to see increase in acreage and farmer benefiting from higher price over last year. We look forward looking at a very attractive launch of schedules in the new slate of brands in the upcoming season. We have a target of introducing 5 new products this year, strengthening rice, cotton, and horticulture portfolio. In keeping our leadership in the exclusive advanced solutions, many products will open new vistas for productivities and higher yields. The integration and management of the specialty horticulture portfolio to Jival is underway, and subsequent seasons will see the effect of distinct strategies. Efforts are also in place to integrate digital technology and augmenting sales efforts and managing customers. PI continues to see excellent in-house technology development efforts with dedicated teams to propagate new technology for such chemistries, and we are gearing up to build new platforms for growth. Given the forecast of normal monsoon development in the agri economy, one can expect present and healthy trends to continue in the coming quarter. Timetable for commercialization of new molecules is attractive, as well as we should be help the situation in sustaining the performance momentum. On our plans for diversification through inorganic approaches, while the pace of progress surely got impacted over the last couple of months with the COVID-19 second wave surge, but we are progressing and are in advanced stages of evaluating of select pharma assets. I would now like to conclude, and you hear from our CFO, Mr. Rajiv Batra. He will share the perspectives and financial metrics and progress made. Thank you once again. Over to you, Rajiv. Thank you.
Thank you, Mayank. Good afternoon, and thank you everyone for joining the call today. I will share the financial performance of Q4 in FY21. All comparisons are on a year-on-year basis and on a consolidated basis. For Q4, we reported encouraging performance with, like Mayank said, revenue growth of 40% at 1197 crores, driven by 47% gains in our CSM exports at rupees 1,006 crores, which has been led by healthy volume increments in our key molecules. This was supported by a 11% expansion in our domestic business to rupees 191 crores, which is very much in line with our business plans. The Sagar demonstrated robust revenue growth of 51% in this quarter. Moving to profitability, EBITDA improved by 22% to rupees 227 crores, which is in line with the higher revenue run rate, and margins stood at 19%. Moderation in EBITDA was on account of lower gross margins, primarily due to two factors. One is a changed product mix in the quarter, as well as reduction in the MEIS benefits, which is the export benefits, which the policy now changed. Profit after tax came in at 180 crores, higher by 62%, benefiting from operationalization of the new SEZ and reduced effective tax rates. Let me also cover the annual performance for FY21. Blended revenues enhanced by 36%, supported by 35% gains in CSM exports and 39% improvement in the domestic business. EBITDA grew 41%, translating to margins at 22%, higher by 90 bps, PAT higher by 62% at rupees 738 crores. Based on healthy operating performance within the year, our balance sheet has further strengthened. We've witnessed significant improvement in free cash flows to the tune of 303 crores. Gross cash flows are in excess of 900 crores, and better working capital management clearly played a major role in this. Net worth almost doubled over the last year due to higher operating profits and the fund which we raised via the QIP. Inventory levels increased in line with our expected growth trends, as well as some proactive safety stocks that we planned to ensure business continuity amid the COVID scenario. Total capex entailed in FY21 was 459 crores. Order book position continues to stay strong at $1.5 billion, with high visibility growth for the next couple of years. Premised on stellar performance during this fiscal, the Board of Directors recommended a final dividend of 200%, which is rupees 2 per share. This, in addition to the interim dividend of rupees 3 that was already declared in FY21, makes a total dividend of rupees 5 per share. This concludes my opening remarks. Now I request the moderator to open the forum for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, please limit your questions to 2 per participant. Should you have a follow-up, may we request you to rejoin the queue. The first question is from the line of Aditya Jawar from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Few things. Will it be possible to break the CSM revenue between molecules which is less than 2-year-old, between 2 to 5 years, and over 10 years? So the question here is that your order book doesn't seem to give a clear indication on the growth trajectory. If we are able to dissect the CSM revenue into different buckets according to the age, it will be quite helpful.
So Aditya, thanks for this question, Aditya. So obviously this won't be possible on this call, but frankly I was also not very clear because you said breaking the revenue, current revenue as per the molecule life and linking it to the order book. So just to explain to you that this order book consists of many of the existing products, but also includes some of the products which are in the launching process or which may also launch in the near future. So I'm not sure how this analysis will, help in that respect.
No, sir. I mean, no. So there was
happy to do that. Happy to do that discussion offline and understand more.
Absolutely, I'll get in touch with you. So the second question is that last year we commercialized 5 molecules. This year we plan to commercialize 3 molecules. Both of them put together represents almost 30-35% of the molecules that are already commercialized. So as we see the ramp up of these molecules, the revenue growth should accelerate. On the contrary, if these molecules are replacing some of the old molecules, and probably that is the reason that order book hasn't changed materially. If you can shed some light in terms of your top line growth guidance is about 15%, that's significantly lower as compared to last year growth. So how much conservatism have we built in that? And what about, the molecule commercialization pipeline that I just alluded to?
Aditya, your voice was breaking in the last part of your question, so I'm not very clear on your question. So if you can please repeat the last part of your question.
So I just said, sir, we are adding almost 35% of existing molecules getting commercialized, and then in last year we added something we'll add in 22. That essentially means that a revenue momentum and the order book accretion should be meaningfully better, unless and until we are replacing a large part of the new molecules. I mean, the existing molecules are getting replaced. If you can, help us understand this.
Yeah, I understood. So, there are 2-3 parts to this question. One is that you're right that we have commercialized 4-5 products last year. This year also we are targeting to commercialize 4-5 products. Now, first thing is that not necessarily that all these products we have created a asset or a new plant, and therefore we have a long term 5, 7, 10 year contract for each one of them. No, it is not correct, because some of these products are fitting in our existing plants, white spaces, and there the approach, obviously, the desire is to have a longer term contract, but then you need to make a trade-off between long-term contract and your flexibility on commercial terms and all. And therefore, the approach from our side always is that if we are putting steel on ground, certainly we would like to have a long-term contract, 5, 7, 10-year contract. But when we are not putting steel on ground and we are fitting some of these products in our existing plants in white spaces, there again, there is no general formula, but we generally want to keep flexibility, commercial flexibility, pricing flexibility with us, so that we can try and fit those molecules according to our wish, depending on what is coming out of pipeline next, and whether and how those molecules may be much more beneficial in long term, and therefore not ending up committing our capacity for long term. Okay? So in short, these 5, 7, 10 molecules in 2 to 3 years doesn't mean that we have ended up in, or we have entered into 10 contracts for 5, 7 years, and therefore that should add to the order book position. That is not the right assumption at your end. There are a couple of products where certainly we have got into long-term contracts, but since we are also on the other side continuing more than 30-35% growth, and the order book is depleting with that growth, the addition of these few products and their contracts have not reflected that much increase in order book. But yes, there are additional contracts which are getting entered, but obviously it has not reflected as such in the increase in order book. I hope this answers your question.
Yeah, absolutely, Sanadi. The next question is on the margin front. We understand that MEIS had possibly an impact of about, say, 200 basis points on a YOY gross margin contraction, but you alluded to one point of unfavorable product mix. If you can help us understand what this unfavorable mix is about, and is it will the mix remain the way it is going ahead, or you expect it to reverse? It would be helpful, sir.
Okay. No, this is a valid question, and in fact, I'm sure that many of my friends will have this question. So I'm trying to kind of give a comprehensive response, and then also request Rajiv to add if I miss something. Okay. Now, on gross margin front for quarter, if we are talking, there is some 4.7, 4.8% reduction. And it is primarily coming, we have done this, you can imagine we have done this detailed assessment internally during our internal reviews and meetings. So primarily this is coming from these 3-4 reasons. One primary reason is the product mix, because as you can imagine that every quarter, and this being a seasonal, particularly the domestic business is a seasonal business, every quarter or every season has its own, product profile or product portfolio requirement, and therefore close to 1.25 or 1.3% is coming from product mix, where the product mix, given the current crops and season and other dynamics, is impacting. I'll request others to please go on mute so that, because there is a lot of disturbance in line. So 1.25, 1.3% is coming from there, change in product mix. And you will also appreciate that with the consolidation of now Isagro business with PI, with Isagro product portfolio relatively lower margin because of their nature, this also is part of this impact that I am talking. The second impact has come from MEIS, which has been explained, and yes, the MEIS in our industry is close to 2%, but there was a truncated impact given the products and nature of products. So I think close to 1.5, 1.6% is coming from there. Okay. Now this MEIS is something that everyone knows is government policy change. I understand that they are working on finding or working out some other kind of benefits for the exporters. But having said so, long-term perspective on this from our side is that obviously as we will negotiate the New Year contracts and new campaign pricing and everything, we would certainly want to pass on the whatever impact on this account is there to our customers. But yes, this is what the current situation is for this quarter. The third again, may I request participants to please go on mute because there is a lot of disturbance. The other major impact is on account of this quarter we have commercialized couple of new products. We have also recently we had commissioned, not in this quarter but earlier this year, but yes, throughout this quarter there was impact of lower yields on this commissioning of new plant in the Jambusar area which we had done. So basically the third reason is that initial hiccups and yields and lower yields and the commercialization of new product, whatever teething troubles that we face in initial couple of months or quarter, that has also contributed to this higher cost and therefore lower gross margin. But this particular aspect has since been addressed, particularly this new commissioning yield, because now sitting in April and May, we are seeing what is the new plant commissioning status and yield, and with the efforts of our team, plant site and other operation leaders, we have achieved our targeted yield, so that impact is not there now. I will not be felt in the quarter one. And on the commercialization of new molecules, again, those processes and new products have now been streamlined, and we do not expect them to contribute to higher cost in the next quarter. I hope this answers your question.
Thank you. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Thanks for the detailed answer on the margin front. Wanted an update on the inorganic acquisitions, likely when we are expected to do something, first half, second half, any color on it?
Sure. Thanks, Vishnu. Well, honestly, on inorganic front, things have been certainly, the pace has certainly been impacted with this second wave and upsurge of COVID because of which, you can imagine the overall logistics, travel, evaluation, discussions, negotiations, all these got impacted. We were expecting to, move to a definitive stage by the end of March or April, but yes, because of this last couple of months situation, things got delayed a bit. But yes, we are at a pretty advanced stage, I would say, in some of these evaluations. And again, hoping that everything streamlines on the COVID front and we have more flexibility maybe in a month or so. I hope we should be able to do or progress on this concretely within this quarter or early next quarter.
So would this be a part of the investment, or just trying to ask whether this entire couple of acquisitions which you're talking about, what would be the outer timeline to do 1, 2, or 3? When would be completing all of them? Any outer timeline?
Outer timeline, we have already.
Any outer timeline?
Outer timeline, we have already indicated, almost 6 quarters that we had indicated. So in that sense, I would say by within this year, we should be completing them.
Got it, sir. And just on the guidance of 15%, generally we talk about 20-25%. Wanted to understand, is it partly because of the, generally we are finding that the global agrochemical market is very buoyant now, given the farm economics and also the massive trade that has been happening. Slightly there seems to be a disconnect from that end where we are lowering guidance where many companies are highlighting strong growth. So if you could just address that part.
Sure. So 2-3 points I'll mention, and then I'll also request Mayank to add something on this. So first of all, as you can imagine, that we have grown very, very aggressively in last year, FY21. We have been for the last couple of years, we have been saying 20% plus kind of growth, but we have grown much faster. Okay. Secondly, even at this point in time, given the kind of product pipeline that we are seeing in R&D and also the kind of outlook that we are, hearing from our customers, the visibility is pretty strong. Okay, growth projections are pretty strong, even in domestic area. This I was talking about export, but even in domestic, given our product pipeline that we are aiming to register in this year and next year, it is quite number of products that we are kind of targeting to register. The only point that we are a little cautious around this is the current COVID situation. For example, for last 3 months, we have seen a significantly serious situation in Gujarat. More than 200 to 250 people, even in PI, was infected by COVID. And I must compliment our teams, our site teams, our leadership teams in operations, who could still manage, with so many proactive actions to deliver what we had aimed for FY21 and even continuing to aim for, current year. So the only, we are very conscious of the current situation and then uncertainties, related to it and potential risks related to it. There is certainly some impact while we have been able to manage our deliveries, we are able to manage our manufacturing and operations, but on development side, we are seeing some impact with these lockdowns and close downs in Rajasthan and in our R&D, in many other, marketing areas where we have to launch products and, some sort of delays are happening there. So while there is, I can say there is upside, but we are really conscious about the current situation. And as has been the practice, we are little conservative in our guidelines in that sense. Maybe you may want to add something.
Yeah, so I think Rajnish have said most of that, but I think obviously we would like to take this view looking at the COVID-19 scenario, and it's a global scenario which we are seeing, and there are certain overflows over the past few years, even for the large companies. So taking all into that, we've taken a little calibrated ourselves to look at this kind of an outlook we would like to stick to for now. Yeah.
Thanks.
Thank you. The next question is from the line of Probal Sen from Centrum Broking. Please go ahead.
Yeah, thank you for the opportunity. Just staying on the question of margins, thank you for the detailed explanation of how the margin has actually come up. But just wanted one idea in terms of, you said that obviously you've recovered the kind of problems that were related to the low yields, related to the new products and the new capacities. But barring the removal of MEIS incentives, is it fair to say that the rest of the impact would get alleviated over the rest of over the next couple of quarters, and we will get back to something like what we've achieved before? Again, taking out the 150-160 basis point impact of the export incentives. The rest of it, can it come back over the next 6 months, in your opinion?
Yeah, you're absolutely right. You're absolutely right. And we have always guided to kind of maintain and manage that kind of, margin profile. Even in MEIS, as I was trying to explain, that while on one side we are hopeful of, given the, ambitious targets that this country has for growing exports, that the Commerce Ministry will come up with some alternatives of benefits to the exporters. We will certainly, as the new campaigns and new year contracts or all these are kind of discussed and negotiated, we would certainly want to kind of maintain our margin profile and pass on these things to the other side.
So going forward, sir, assuming, of course, as of now, if there is a alternative scheme announced and some sort of alleviation happens on the government side, but barring that, if I look at FY21 as a whole and then look at FY22, we should be working with maybe 120, 130 basis point lower EBITDA margin, just as a benchmark. Is that a fair way to look at it right now?
Well, my sense is that we would still want to, guide for the similar kind of EBITDA margins that we have achieved in this year. But I would request Rajiv to give a perspective on this. Rajiv?
Yes, Rajnish, I think very much you stated it absolutely. The attempt will be between the new scheme with the government announcing, which I believe is only 2 weeks away, and the fact that we would like to pass on to the extent possible, even the differential back to our customers. The mix issue, again, there'll be some ups and downs, but the point is that so far we've been on a path and we should be towards our guided margins. And the new plant startup, which we talked about, we've already made the investment and therefore the efficiencies have now been achieved, so I don't see a concern there. So basically what we just stated is what I would reaffirm, that we would plan to come back to a margin at some point in the year.
Right. And so the second question was with respect to the capex, leaving aside the QIP proceed deployment. This year, would you say that the capex was perhaps lower than what you would have wanted because of COVID-related disruptions? And
no, I really want
22 as well.
Our guidance would be that our main capex cycles, the investments, will not be at that pace that you've seen in the past. The last 2 to 3 years, we've been through a heavy capex cycle as we created our capacities in newer facilities. That part is done, and even in the last call we said we would like to, in fact, move our fixed assets to revenue ratio with that turnover up, which you may see we have made a little start on the journey this quarter. And through a newer application of techniques, we would continue on that journey. So biggest CapEx we will be seeing would be on the inorganic acquisitions, which we've talked about. Here we would like to, in fact, now sweat our assets.
Thank you. The next question is from the line of Ritesh Gupta from Kotak Securities. Please go ahead. Mr. Gupta, your line is in talk mode. Kindly go ahead with your question, please.
Hi, am I audible?
Yes, sir, you are.
Yeah. So just one question on the pharma side. You've been talking about an acquisition, but could you just highlight a bit on the organic effort that has gone that side, and what do you really intend to do with the acquisition? I mean, is it like a full-blown acquisition where already there would be clients, etc., and it will just be like a plug and play, and you will kind of add to it? So if you would just lay upon what are you on the pharma side, what are you intending to do, given that you already identified the target? B, I think on the non-pharma side as well, if you could just update us on the progress. And I mean, I think a few quarters back you had highlighted that you would like to have 20% of the revenues coming in from pharma in the next 3 years or so, if I remember correctly. So just want to speak an update on that. Do you think it's still possible?
Well, I'm afraid you'll have to repeat your question because your voice is not very clear. There is a lot of buzz around and, it's not clear. So maybe if you were talking from headphone, please try. Yes, this is now sharp and better. Yes.
Yeah, no, so I just wanted to check on the non-agro piece, revenue growth initiative that you're taking. Yes. So I think 2-3 quarters back, or when you did your QIP, you had said that I think you're looking at 20% sort of revenues to come from non-agro business from pharma in the next 3 years. So A, is that guidance still intact? B, I think when you've identified the target and you're probably closer to the closure, I just want to check what kind of strategy you will have with this kind of acquisition in terms of what will it be like more like plug and play, or would it be complementary to your existing organic efforts? And third, on the non-agro and non-pharma side, any progress there? I could see some talk about fermentation technology, etc., also over the annual report and all. So could you just talk about some of the other initiatives there?
Sure. So on pharma side, yes, you're absolutely right. We are, as part of our long-term strategy, we are looking at, something which can help us, speed up this scale up of pharma vertical that we are wanting to, build. We have already, over the last few years, in-house developed certain technologies. We have already kind of built some set of, I would say, intermediates and therefore some set of customers already working on certain additional inquiries, product pipeline in-house, okay? But in order to scale up this whole thing much faster than what we did in CSM space in AgChem, we are looking at this inorganic opportunity, and we are looking at something which is plug and play, which is also complementary to what we have built in-house, and the kind of technologies which we believe will help us kind of create a differentiated position for ourselves. And these technologies, unique technologies, are I may not speak too much about it on the call, but we believe that we have certain technologies whereby by combining those technologies and the product portfolios and the access to the customers that we are expecting to get with the inorganic opportunity, we will be able to create a differentiated position.